Greeting to all the students. Welcome to Global Online. And here we are back with our target of 1000 MCQ series. And this is a part 16. And here we are going with our unit number 4 of commerce and unit number 5 of management. That is the financial management and the business. And here we are discussing, or we are going to with our most expected and most repetitive questions which you have seen in your examination. And the questions which are frequently asked in your examination, that will be taken by me, that is Dr. Swati, your educator. And here we are doing all the MCQs, and these MCQs are really important. And here we are discussing all these MCQs in a very deep explanation. Yes, before we go ahead, the session for of the day, let's understand what this global online has to offer you. So the global online is brought a quick revision, brought over here for your the quick revision of all the your course of the commerce and management. Here you will get a daily live lectures, complete syllabus notes, MC mock tests, more than 4,000 MCQ series with detailed explanation, PYQs. And here, if you register yourself for the paper 2, you will get paper 1 is free of cost for you. And Global Online provide you 50% discount on the fees. So this offer is very limited offer for you. So in this 5,000 amount, you can, if you register yourself for the paper 1, paper 2, you will get paper 1 is free of cost. And our new batch going to be started from the 8th of the July. And in every Monday we launch a new batch for this student. For more detail, the contact number is given in your screen. This is the WhatsApp contact number. Get in touch with this contact number for more detail. So, how to download the Global Online app? So, go to Google Play Store. Just download the Global Online. Make a registration. After that, you find that there is a My Course section, and in the My Course section, whatever the course do you have or do you want, just register with that course. Okay, and after that, you can see the actually interface of our app is looking like this. Here, you will get unit-wise folder or the materials and the MCQs and the recorded lectures which is already available in the app. So and the live lectures is already is going to be provided every day. So let's join the global online. Let's start with the first question of today, that is, which one of the following statements are true? So here the first option is given, that is a payback period method consider all cash flow of the project, which is true. Okay, option number 2, payback period method concern more with the recovery of a cost than the profitability or the net present value represent in additional to the wealth of the shareholder. And option number D, that is accounting rate of return incorporate with the risks as well as a time value of money. So the option is given A, 1, 2, 3, 4. So here is option is given. So just stop this video, try it with yourself. After that, I will be there for you to explain the things. Now, before we go ahead, just look over here. That is what is the first thing? What is payback period? Payback period is the technique of the capital budgeting. But in the techniques of capital budgeting is categorized into two it categorized in two way, that is a traditional method and in the modern method. So what is modern method? In the modern method, there is a time and the risk time factor, and they give the emphasis on the time factor and the risk factor. But if you find that in the traditional method there is no time factor, there is no time factor and the risk factor is given. So in this, what in the traditional method, you can see there is a payback period and there is an average rate of return. Yes, so average rate of return in the modern techniques, what do you see? There is a net present value, IIR, that is internal rate of return, then modified IIR, and the profitability index. Okay, so what the question is talking about? The question is about, that is, payback period method consider all the cash flow of the project. He is talking about the payback period. So is it payback period is considering all the cash flow of the project? No, ma'am. It's not considering all the cash flow of the project, because it's not depend on the time, it's not depend on the risk. Okay, and here is not a days, actually it's not depend on the cash flow of the project, because and the payback period, second thing, method is concerned with the more with the recovery of a cost than the profitability. Yes, payback period, that is a payback period is means in a particular time, in which duration of the time you will get your money back, not your profit back. Okay, so yes, it is true. Yes, it go give to more emphasis on the recovery of the cost, not on the profitability. Okay, if you invested somewhere else, so how many years you will get your money back? Okay, not a profit. You will getting the additional profit. That is a different thing. This is not a payback period, but you are concerned about your cost. So it is a pay. It is your payback period method. Okay, now the net present value represent the net additional wealth of the shareholder. So here, in the net present value is it is the modern techniques of the capital budgeting. So yes, they are involved, they are interested, they are more interested in the wealth of the shareholder. Okay, so it is also true. Then the accounting rate of return method incorporated with the sorry, this is yes. So is incorporated? Yes, it is right. Incorporated with the risk and the time value of money. I have already told you that is traditional method. They having a two, that is payback period and average rate of return. In the average rate of return and in the payback period, they are not giving the emphasis on the time and the risk. Okay. Okay, that's why the option number D is going to be wrong over here, because the time and the risk factor is given in the net present value method, in the internal rate of return and the profitability index method. So here the option number B and the C is right over here. So the option number 3 is right over here. Clear? Hope you understand. Now the next question, just write with yourself. I will be there for you. Okay. Now the question number the next, that is arrange the following finance choice in order of preference suggested by the picking order theory. So first the picking you have just give the answer. Okay, the option is over here, that is a reinvestment of the earning, new issue of the equity share, issue of the debt, and the choose the correct answer from the option is given below. So first of all, in the pick, what is the picking order theory? If you are aware with your picking order theory, you can easily answer this kind of question over here. Okay, so first think whenever whatever this generally whatever the company follow the things, that is in you can see that there is an uh, yes, there is another thing, that is increasing risk. Hence what is over here, the company said, or the author says, or the theory says, actually the theory says that first of all, whenever you need a finance, whenever you need money for your company, you have to use your internal financing, that is your retained earning, whatever you have retained. So just use this finance for your in your company, because it is having the no cost. Okay, it is having the no cost, this is the most important thing. And it is also having the no flotation cost. Okay, either you can say there is a very less flotation cost. Okay, so less flotation cost over here. So what is the flotation cost? That means flotation cost means whatever the interest when you collect when you get a finance from the outsider, when you get money from the outsider, so you have to pay the debenture holder, you have to pay the interest, for the equity shareholder you have to pay the dividend. So whatever this is a float, the interest and the dividend, whatever you have paying, so this is a flotation cost. So here what is there is a no risk of, or there is a no tension of the paying the flotation cost to the debenture holder or the equity shareholder. So first thing you have to do, whatever you have in your hands. Okay, so you use that thing. and after that you have to go with your external financing. In the external financing you have to, in the external financing also categorize in the two things, that is you have to, if you're having a chance, that first you have to choose the debt financing, that debt issuance, or after that, after a debt issuance you have to go with the equity. Why he choose a debt issuance? He choose a issuance because here is the interest of whatever the interest or whatever the floating charges here, yeah, the company had paid to the debtors. So interest rate is fixed, and there is a no right of the debtors in the company. So that's why the one more thing, that is there is a tax benefit is also given by the government. So that's why they the company the picking up theory said that you have to focus on the first thing. If you are choosing to, you are going with the external source, so what you have to do, you have to just choose first the debt, and once you first and after the debt you have to go with your equity share, because equity having there are risks of there are so many risks is involved. Okay, that's why the equity is a, because in equity when you're paying the dividend, you have to, in the dividend you also paying the there is a no deduction is available in the tax. Okay, so this is things. And in the capital structure you can see there is an in the capital structure there is a relevance theory. Okay, in the capital structure you can see there is an irrelevance theory, and there are the other theories, which is this in the other theory you can see there is a trade-off theory and the picking order theory. Okay, so, and the picking order theory is the other theory of capital structuring. In the relevance there is a net NI approach. Okay, net income approach, traditional approach. And the irrelevance you can see there is an NOI approach and there is an approach. Okay, so these are. So according to whatever we have seen, so according to what I say to you, first of all, whatever you have written, whatever which is in your hand, just use that thing. So here is the first thing, that is the reinvestment of the earning, that is a retained earning you have to use. Okay, so the first thing you what is, this is the arrange. The first preference is retained earning. Second thing, issue the debt. Okay, and third thing, that is go with your equity. So here is the right answer will be A, C, B. So where it is A, C, B. So option number B is right over here. Okay, clear? Now the next question. Now the next question, that is question, which of the following statements are correct? So option is given, that is a dividend payout ratio refers to the proportion of the total earning which is distributed among the equity shareholder of the company. Bird in hand agreement is given by the Gordon model, and MM model suggested that dividend payment is very relevant for the value of the firm, and the Walter model suggests that dividend payment does not affect the market price of the share. So this question is given. Just try it with yourself. The question is about the correct one. Okay, so just try it with yourself. Now I'm going to tell you what will be the right answer for this question. So what is a dividend payout ratio? In the dividend theory, there are the dividend theory is divided in the according to their relevance theory and according to the irrelevance theory. So what is the relevance theory? So relevance theory is which is considered the decision to the relevant as the affect the value of the firm. Okay, that means whatever you are choosing, whatever the things you are choosing, the whatever things, that means in the dividend theory you either you retain the 100% of your profit, either you pay the dividend as to the its share to its shareholder. Okay, so in the relevance theory, if you retain your 100% whatever the profit you are gaining, and if you retain it, so it is a relevant, that means your value of the firm going to be increases. In the irrelevance theory, the it is considered that there is a no effect, not affected by the value of the firm. So there is a no either you are retaining or you are paying to the dividend to the equity shareholder. So there will be no effect on the value of the firm. So and the relevance theory is given by the Walter model and the Gordon model. Okay, but irrelevant theory is given by the Modigliani and the Miller model and the traditional approach. Okay, and here is, so here what is a dividend matrix? So in the dividend matrix you can see that is a dividend per share. Dividend per share is the amount of dividend issue as a per share basis, issue as a per share basis. So here you can see there is in the numerator dividend, annual dividend divided by number of share outstanding, that is a dividend per share. In the yield, dividend yield, you can see there is divided by the share pricing. Okay, DPS, that is dividend per share, is when your dividend per share is divided by with the share pricing, so it is your dividend yield. And what is a dividend payout ratio? So the dividend payout ratio is a dividend per share, annual dividend per share divided by earning per share, how much you earn in every in per share. Okay, so this is a payout ratio. Okay, now uh yes, what is our question? The question is talking about the dividend payout ratio is referred to the proportion of the total earning which is distributed among the equity share of the company. Yes, it is true. In the dividend payout ratio, what the company do, whatever the total earning they have earned, that total earning will be distributed to its equity shareholder. In which ratio? That is a dividend payout ratio. What we have seen in the formula, that is annual dividend per share, how much annually you have paid divided by how much you earn from per share, that is the earning per share. Okay, now the next one, that is the first, that is A is correct over here. Now the bird in hand argument is given by the Gordon model. Yes, this is it true, because the bird in hand, whatever the amount you have, whatever you retain in your hand, whatever the things in your hand, just utilize that thing. If you have the retained earning, just utilize that retained earning. If you have your date, so use that date. So that is the bird in hand, whatever you have in your hand, just use that things first, that is a bird in hand. So this is given by the Gordon model. So these both things are true over here. Now the model suggests that a dividend payout is very relevant. No, actually, in every theory, you can see that in the model, he is just opposite, or he say that there is a no relevance. So it is not relevant. It is a no is irrelevant. Okay, the Walter model suggests that payment does not affect the market price of share. Actually, Walter model is basis on the relevant model. Okay, we have already seen, that is Gordon model and the Water model give the emphasize it to the relevant. They say there is an relevancy, and actually in this question here's what is talking, there is a dividend payment does not affect, actually it is affect. It's said by the Walter and it is said by the Gordon. Okay, yes, so the option number A and B is right over here. Okay, uh yes. Now the next question, which is in your screen, the assertion is given that is according to the net income NI approach, capital structure decision is relevant in the valuation of the firm. So here is the question is, assertion is given in the NI approach. Okay, in the NI approach, that is a net income approach. Okay, this is the approach of the capital structuring. We have already seen, and a decision is relevant in the valuation of the firm. Yes, because an approach and relevant approach of the capital structuring are the NI approach and the traditional approach. Okay, so the traditional approach and NI approach, it's a depend on the it is said that there is a relevance of the valuation of the firm, and how the valuation of the firm going to be increases if your cost of, that is KO, cost of capital going to be decreases. So the ultimately, if your WACC, overall cost of capital, is going to be decreases, in that case your valuation of the firm going to be increases. So their question is that how do you reduce this cost? This is the question. So there is a two possibility, that is there is a K, that is cost of equity. Either you use a cost of equity, either you use a cost of debt. Okay, and the NI approach say that there is a constant, that is there your KD, that is cost of capital, and your cost of equity are constant. If gradually if you are increasing your cost of debt, gradually your cost of capital is going to be decreases. Okay, so here is a, and your cost of equity is constant. Okay, so NI approach say this. Okay, and this is, yes, this is a true assertion, is over his assertion is true. Now the reason is, the firm can change its total value and its overall cost of capital by change in degree of leverage in the capital structure. So Doctor, this is your time. Just pause it and just answer me. I have already told you that is why the assertion is right. Now there is a times of reason. Okay. So now in the reason is that the firm can change its total value. Yes, firm can change its total value and its overall cost of capital. Okay. That is total value. That means value of the firm or overall cost of capital, WACC. Okay, by change in degree of leverage in the capital structure. Yes, there is a direct relation of the degree of leverage and the capital structure. Okay, so in the capital structure, so here you can see, look over here. So in this, the NI approach is given by the David Durant. Okay, and he said that there is this is a cost of debt, and this is a cost of equity, and this is a KO, cost of capital. So in this say they use 100% use of the debt is a best optimum capital structure. So the thing is optimum capital structure. What is the optimum capital structure? So in the optimum capital structure, it's that means uh, when you're increasing your debt, your earning per share is going to be increases. And if your earning per share going to be increases, your value of the firm is going to be increases. And if your value of the why your value of the firm increases, because your overall cost of capital, that is your WACC, is going to be decreases. Okay, so that's why this is the reason. If you use 100% use of your debt, so this will go going. And here you can see this theorem. The a firm may increase the total value of the firm by lowering its cost of capital. If the cost of capital is decreases, value of the firm going to be increases. So it's depend on their leverage. Yes, it's all happened just because of the change in degree of leverage in the capital structure. And in the degree of leverage, you can see in the leverage there is an uh, cost, there is a relationship between the cost of capital, cost of debt, and cost of equity. Okay, yes. So here is there is an option number A and R are correct. Yes, and the R is a correct explanation of the A. Okay, yes. Now why it is relevant? Okay, now the next question which is in your screen, this is a matching question. That is question number 1 is given over here. That is matching. Yes, now the liquidity risk, business risk, finance risk, inflation risk. Okay, this risk is given, and you have to match with your what this risk is related to. So here is, just try it with yourself. Okay, then I will tell you. Okay, now let's understand the things first. What is a risk? So here What is the risk? So here you can see the risks are divided into two parts. There is a systematic risk and there is an unsystematic risk. The systematic risk means which you can, there is an the systematic, okay, there is a systematic risk and there is an unsystematic risk. So the systematic risk that means if anything is systematic, so you do not need to control it. That is, you, this is uncontrolled by the organization not going to be control it, and this is a macro concept. What? Systematic risk is a macro concept. And when we draw a diagram, you can see this is a systematic risk, and in the and here you can see there is an unsystematic risk is like this. Okay, so unsystematic risk, that means control by the organization. The which risk is it is controlled by the organization, that is the unsystematic risk. And the unsystematic risks are the internal, having the influence with your internal factors. Okay. And your unsystematic risk is controllable, and it is a macro, having the macro in nature. Yes, and it is it is a, and in the systematic risks, and sorry, in the unsystematic risks, there you can see there is a business risk and there is a finance risk. Okay, because in the you can control. Okay, you having a control in your business. Okay, so internal, whatever internal or the external risks. Okay, so business risks, that is business risks is having the two risks, that is the internal risks and external risks. Yes. In the finance risks, having the credit risks, having the currency risks, having the country risks, having the liquidity risks. So the credit risks, okay, in the currency risk, there is a possibility that the value of the currency going to be increases or then going to be decreases. So there is an inflation or there will be the deflation. So there, this is a possibility that there is an unsystematic risk. You can, this is having the macro in nature, and unsystematic, you having the, that is a, or organization can control this kind of risk. Okay, in the systematic risk, the market risk, interest risk, and the purchasing power risk. Okay, so in the systematic risk, you can see that in the systematic risk there is a variability in the interest rate. And just give me a second. Hmm. Yes. In the systematic risk, there is a market risk and there is yes, there is a market risk. Okay, there is an interest risk and there is a purchasing power of inflation. So in the in the interest risk, interest rate risk, what is there in the, it is there is a, you can see in the, there is a variability. There is a variability in interest rate according to the time to time, and it in a particular it's affect the debt security as they carry the fixed rate of interest. And in the market risk, there is a fluctuation, okay, seen in the trading price of any particular share of the security, and that is arises due to the rise or fall in the trading price of the listed share of the security in the stock market. And these types of risks arises due to the movement in the price of financial security. Yes, and in the purchasing power of the inflation risk, what purchasing power risk is also known as inflation risk. Okay, in the inflation risk, you can see there is there is an effect by the purchasing power adversely, and it's not at a desirable investment in the security. So these are the risk, are the systematic risk. So here you can match. How do you match it? This is a question. So you know that there is a liquidity risk, there is a business risk, finance risk, inflation risk. So you know that business risk and the finance risk, these are the unsystematic risks. Okay, and the liquidity risks and the inflation risks, these are the systematic risks. Now is here's the, in the question there's not talking about the systematic and unsystematic. So let's start. How do you going to be matched? So you know that purchasing power of the income, so this is reflected by the inflation. If you're you can see if you're inflate, there is a chance of inflation in the market. So what is affect going to be affected? The purchasing power. And what is going to be affected? Of your income. Because inflation is going to be increased as your income is not going to be sufficient, and the price of the and the purchasing power will going to be decreases. So there is a directly effect of the purchasing power of the income. And after that, so the D is matched with the 1 over here. Okay, now uh okay, D is matched with 1. Now the liquidity risk in the liquid now the financial risks in the financial risks related to the capital structure. With the risks which is related to your capital structure, this is a financial risk. Business risk is related to your due on the time. Okay, so it is due on the time. So the B having the 3, B having the 3, and the liquidity is the fluctuation in the profit. uh Sorry, there is a mistake. Okay, so the liquidity risk is it is your liquidity risk is your the risk related to inability to pay is due on the time. So that is your liquidity. How much the money you have in your hand. That is a liquidity. If your liquidity is less, if you're not the company is having the less liquidity, so he's having the inability to pay the due on the time. So that's why the A having a 3. Yes. Okay. And after that, the business risk having the fourth one, that is the business risk is risk related to the fluctuation in profit. Because business is what? Business is doing for the profit. If you see there is a business risk, so there is, you can see there is a fluctuation in the profit. So according to question, so the right answer will be option number fourth one, that is this one. Clear? Now, the next question, that is standard costing. Margin, again, the matching concept is given, because in the matching concept, you can say there is a much more concept is going to be discussed in the single question. Okay, so just try with yourself. Okay, just pause the video. I'll be there. Okay, let's start with the question. That is, a list is given and the explanation and the related concept is given. So, you know that standard costing, margin of safety, ratio analysis, and just in time system. So, just is first thing, that is just in time system means whatever the material, whatever the inventory you want, just get that inventory at the time when you need it. Don't or do the overstocking of the inventory. So this is a just in time system. So just in time system is, it is related to your control of the inventory. How much control you have in your inventory. Okay. Yes. Now the what is the margin of safety? So you know that what is the margin of safety? That means whatever the break even point is your, okay, what is your break even sale? From that break even sale, whatever you sell, if you if you deduct, suppose your sale is at 10 rupees, suppose, okay, and your break even sale is 5 rupees. So what is your margin of safety? That is 5 rupees. So this is your margin. That means you safely manage your margin, your safety. That is, if yes, this is my break-even point, where your total cost, is equals to your revenue. Okay, so in that points, whatever you have cost, you have actually paid, and whatever you gain, the point at which these two things going to be equal, that is your break even point. So the margin of safety, that means apart from this break even point, how much you safely save, okay, for your special growth, or okay, because the profit, the margin you have to manage, because if you are not managing, so you're not stay able to stand in the market. So this is a margin of sale, that is a sale minus break even sale. So here is B is having the 2, B is having the 2, and D is having the 3. Okay, D is having the 3. There is a 2 option, so this option going to be cancelled, and this option to going to be cancelled. Now what is A ratio. What is the ratio analysis? So in the ratio analysis, what you see in the ratio analysis, in the ratio analysis, you do the ratio analysis because you want to forecasting or planning of what your financial. So financial forecasting and financial planning forecasting, you need a ratio, the percentage, whatever the gross profit ratio, what is the net profit ratio, what is price earning ratio, what is your liquidity ratio, what is your activity ratio, what is your profitability ratio. On the basis of this past year ratio, you can easily predict your future profit. Okay, so this is a ratio analysis. Now what is the standard costing? So the standard costing, it is your management by the exception. So in the management by the exception, the standard costing, why the management by exception? Because here the management give the give the plan, give the target to the his employee, and he is not giving too much stress to the employee. He want to just do it with yourself in a specific time period. Okay, so this is the management by exception. So according to this, you can see that it is age match with the four. So the option number A is right over here. So whatever I have explained, I will just quickly tell you in the this format. So here you can see there is a purpose of what is the standard costing. So the standard costing having the four purpose. What is the four purpose? That is the management by exception, which I have already said. That is management give you the target, and in the specific, and management not stressing out to his employee. He just giving the target, just do it with yourself. How do you're doing, how do you're finishing it? Okay, with your best performance, with your whatever the strength you have, just use that strength and just do it, okay, without stress. So this is a management by exception. Another purpose of the standard costing, that is employee motivation. They are giving the more focus on the employee motivation, how to motivate them, how to enhance their performance by evaluating, and the sensible cost comparison. So these are the purpose of the standard costing. Clear? Yes. Now the thing that is which I have explained to you. Here you can see what is the break even point. So break even point, that means where your total cost is equals to your total revenue. This point is your break even point. Okay, and from this break even point, you have sell your product. So this is your, this difference, it is your margin of safety, and the how much different you have seen over here. Okay, so this is your profit from the total cost and the total revenue difference. Okay, here it is, this is a profit, and this area below the break even point area, it is the company's loss. Okay, yes. So what is a just in time? Just in time, it is an inventory management system which aim at procuring the raw material, labor, and when required without investing in storing it. Okay, don't invest in storing it. Okay, whenever you need it, just order it. Okay, so this is what is the advantage? Reducing the cost of storing raw material. Yes, less investment in the raw material, speeding up the manufacturing process of the material availability of the readily. Then they eliminate the lead time, we help in the shorter the production run, and they eliminate the wastage. Okay, so there the wastage of time also, wastage of transfer also, wastage of inventory also. So here you can see there is a success factor. How much success factor in the just in time? So in the accurate determination of the demand, maximum coordination between the department using the Kaban system. Okay, what are the disadvantage? Lead to potential to supply of the chain destruction. Yes, you have to be many attentive. So what you have to be many attentive, that is how much inventory we have left, how we need it. So you have to be updated with it. So don't there's a possibility that lead you to the potential supply chain destruction. Okay, and the manufacturer have no margin to make the error. There is no margin to they make a error. Okay, and unable to meet any unexpected order from the customer and no time for the recognition of the customer. So this is the this is a just in time factor. Now the next question which is in your screen, that is, under which of the following situation the decision outcome on the evaluation of the investment opportunity vary under the NPV and IIR method as per net present value method and internal rate of return method. Okay, internal rate of return. So the question is talking about the situation. The following situation is given. In the following situation, when you in the decision outcome, in the decision outcome on the evaluation of the investment opportunity vary under the NPV, net present value, and IIR method as per the. So here you can see there is a time disparity, there is a cost disparity, and there is a life disparity. Okay, and there is a volume disparity. So which factor is going to be impact on these both things? Okay, so here you can see whenever we are talking about then the net present value and the NRI, so how do we calculate the net present value from the how do we calculate from the present value of cash inflow? When we deduct the present value of cash inflow from the present value of cash outflow, so we will get net present value of the value. Okay, and how do we calculate the NRI? From the present value of cash inflow, we divide the present value of cash outflow. Okay, so here what they are going to be giving importance to their time disparity, yes ma'am, the cost disparity, yes ma'am, and the life. There is a no relation with their volume disparity. So the option number A, B, C is right over here. Let's discuss it. Okay, now yes, here what is the conflict result arises because of the reasons are given. So here you can see that is a significant difference in the size of amount of outlet of the proposal. The problem here you can see the problem of the difference in the cash flow pattern and timing of the various proposal. Okay, timing of and in difference with the several life of or unequal expected life of the project. Okay, in such case, while choosing among the mutually exclusive project which are mutually exclusive, that is they are no, if one happen another will not happen, that is a mutually exclusive. If the head is come, so tail will not come. If the tail is come, head will not come. So this kind of project is called as a mutually exclusive. One should always select the project giving the largest positive net present value using the appropriate cost of capital or predetermining the cutoff rate. The reason of the same lies in the fact that objective of the firm to maximize the shareholder wealth, and the project with the largest NPV has a most beneficial effect. Largest, if your NPV, that means your inflow is larger than your outflow. If that means your NPV is greater. If your NPV is greater, you can see there is a most beneficial, okay, and its effect on the share prices and shareholder wealth. Thus, the NPV, net present value method, is more reliable as compared to the IIR. Okay. Yes, and IR method is a ranking mutually exclusive project, and in fact, NPV is the best operational criteria of ranking mutually exclusive investment proposal, and the value disparity does not lead the volume disparity. Okay, does not lead to conflict between the NPV and IR decision. Okay, yes. So that's why the volume is not affected with NPV and IR. But yes, NPV and IR is affected with time, cost disparity, and the life. Okay. And if we, when we are going to compare it, so the NPV is, you know that the NPV is more beneficial than the IR and more reliable also. Okay. So the next question which is in your screen, select the technique used to decompose the different drivers of the return on equity in the three major factors. So the option is given: liquidity analysis, profitability analysis, due point analysis, and the comparative analysis. So what will be the right answer for this question? If you are known with your the terms of the return on the equity, you can easily mark this question. Okay, so just try it with yourself. Now I will tell you, that is the select the techniques used. Okay, the decompose of the different drivers of the ROE. So in the ROE, into the three major factor, the ROE is distributed in three factors, and these three factors are net profit margin, okay, return on asset, and the financial leverage. Okay, so here the formula of the net profit margin is net profit divided by sale. Okay, return on asset is also having the formula of the sales divided by asset, and the financial leverage, you can see there is an asset divided by the equity. Okay, so when we multiply this all the three factors, 1, 2 and 3 factors, so you can see that the sell asset going to be cancelled. So what is a relation? So in the ROE is a relation of the net profit divided by the equity. Okay, so these are three factors. The question is, these the three factors, drivers of the ROE is given, is this analysis is comes under which analysis? So this analysis is comes under the DO point analysis. By whom? By the DO point analysis. Clear? Yes. Now the next question which is in your screen, that is a fixed working capital is generally financed by. So here is, you can see the question is about the working capital, and this working capital having a nature of fixed, that means you can say it is a permanent working capital, ma'am. Yes. So option is given. Option number A, by long-term capital fund, by the government aid, by the international financing, by the short-term loan by from the one bank. So what will be the right answer over here? So you know that what is a working capital? Working capital means whatever your for your running the day to day operation of the company, you need some money, you need some working capital, and working capital is nothing but your gross asset. What is it? Is your gross asset. From the what is your net working capital? From the current asset, when you deduct your current liability, then you will get your net working capital. Okay, so what is it? What is the so the working capital is having divided according to the temporary working capital and the permanent working capital. Okay, so for the temporary working capital, the short term, either you can say short term, and this is either you can say long run. Okay, long run, or you can say the fixed working capital. So here, this is generally what you have to do. What you have to do for temporary working capital, you have to finance temporary working capital with your short term finance, short term capital funding, and your permanent or the fixed working capital you have to finance with your long term funding. Okay, so this is a standard criteria. Okay, so here the fixed is talking about the fixed working capital. That's why the option number A is correct over, that is by the long term capital funding over here. Okay, so let's understand the things first. Here you can see that is working capital is that is, it is a net working capital. So in the net working capital, here there is a working their current asset, current liability. So when it will be aggressive, when it will be moderate, when it will be conservative. So first of all, understand that is when it is a conservative. Conservative when your higher your working capital. If your working capital is higher the working capital, that means you having the liquid amount which is in your hand is more, okay, that is your working capital high. That means your current asset is greater than your current liability. So here what is happen over here, your liquidity is high. Yes, it is your liquidity is high, but your profitability going to be decreases, because what you are doing over here, for from the permanent working capital, for settling the permanent working capital, you are using the long term debt. For settling the temporary working capital, you're also using the long term debt. So what is happening over here, your everything you just when you're using, so here you are not wanted to losing your liquidity, but either you just wanted to losing your profit over here. In the moderate working capital, there is a moderate profit and moderate liquidity, there is no too much. In the aggressive, what you happen if with your short term, with your short term, you just want to fulfill your fulfill for the short term, for your short term funding, you're solving your long term long you just want to solve your what I'm saying, capital funding, okay, long term capital funding, okay, here. So here you can see working capital is divided into two parts, basic concept and the timing. According to basic concept, you know that gross working capital, net working capital, which I have already told you. Okay. According to the on the basis of the time, there is a permanent working capital and there is a temporary working capital. So in the permanent working capital, there you can see the regular working capital, reserve working capital. In the temporary working capital, you can see the seasonal working capital and special working capital over here. Now let's understand the concept of the aggressive and the moderate and the conservative. Okay, so here what is it, there is a temporary working capital and permanent working capital. So what the conservative is, conservative is talking about, if you having the short term if you having the short term you have to just manage your short term financing, so you use for the short term, you have managed with your short term funding. If you're having the long term funding, so you have to manage with your long term financing. Okay, so here for the temporary working capital, here they're using the long term, and for the for short term also using the long term. So this is a conservative, because he has ready for bearing the losses or the reducing his profit, but is not ready for the reducing his liquidity. So this is a conservative. That means you're conserving, the company want to conserve self. Okay. So what is a moderate? In the moderate, whatever the short term funding is, so this short term is to be solved, is using for the temporary working capital. Okay, temporary working capital is used for the solving the short term capital, and the for the on the basis of with the use of permanent working capital is used by the long term financing. Okay, so here this is a moderate. What is the aggressive strategy? In the aggressive strategy, they what they use, with the help of short financing, they solve their uh, permanent working capital things. Okay, so this is aggressive nature. With your short term things, you want to solve your permanent thing or the fixed thing. So this is your aggressive nature, which is opposite to your. So here there is a possibility you are there's a best example of you, either the school, if your child, if your sister or the or your relative sister relative anyone, if you seen that so the school the school say when you're going to be admission, taking the admission, so they are offering you, either you pay the full amount and you will get a 10% of the discount on the fees, either they say 15% or they didn't say 7 20%. But if either you having the chance, you have to do with a 3 installment, okay, 1, 2, 3 installment, okay, but there will be no discount is going to be there. So what they are doing, they are using the aggressive. If the someone used to pay at the full amount at a one time, so yes, there you maybe earn the 10% of the profit, 10%, 15% of the profit, or 20% of the profit. But what is happening, whatever the liquidity in your hand, whatever the cash which is in your hand is going to be reduces. Okay, this is a best example of the aggressive working capital. Okay, but if you are going with your if you are not choosing, if you are not choosing with your, if you're not going with your discount, okay, one time payment system, okay, if you're choosing the installment system, so this is a conservative working capital. So what you're doing here, you're not getting any kind of profit, you're not getting any kind of discount, you're not saving any kind of money, but you having the liquidity in your hand, because you are not paying the all money at a time. You're not engaging your cash, engaging your money, and the at a one time, you having the whole of that money. So this is an aggressive and this is an conservative. So hope you're with the example, you're easily understand the concept. Yes. So I have that I'm just started from these with this week. This is a business finance unit, and you just join our class, because it will give you a more advanced, more more in depth advanced in depth depth, you can say, that is in depth explanation and concept building. Okay, so we are just we are in this unit. Okay, now which source of the capital is used to get a financial leverage? For the financial leverage, which what capital, which source of the capital they use? Option number one, debt capital, equity capital, long term loan, or the short term loan. So what will be the right answer for the financial leverage? For the financial leverage, what is the formula of the financial leverage? The first question is that what is the formula of the financial leverage? So in the financial leverage, they giving the importance, in the financial leverage, they giving the importance to the debt capital. Okay, they giving the importance to the debt capital. Okay, why? Because they say that if you're increasing your debt capital, so if you're using the debt capital, so it will give the value of the firm going to be increases. Okay, and what is, there is a cost of capital going to be decreases, and your back, the overall cost of capital going to be decreases. So the financial leverage it's a source of capital which is used to get a financial risk, that is a debt capital is which we have used for the financial leverage. Clear? So thank you so much. We have completed over here many questions. Hope so you are enjoyed it, and hope so you're betterly clarified your doubts about it. Okay, so see you soon in the next